The Economic Reset, Ray Dalio's economic predictions. Given that cracks are only now appearing in the key automobile and real estate sectors as the Federal Reserve continues to aggressively raise interest rates, we agree with Ray Dalio's thesis that economic conditions will likely worsen significantly in the coming years. Given that these sectors account for a sizable portion of the S&P 500 and are generally representative of the broader economy, a drop in one or both of them in the coming months and years would almost certainly spell trouble for the SPY. In this video, we will look more closely at these risks and offer our perspective on the current economic situation. Recently, billionaire Ray Dalio said, "We are starting to see all the classic early signs of a recession." In the wake of another substantial interest rate hike by the Federal Reserve and a very hawkish outlook on continued interest rate increases that made clear the Federal Reserve's number one priority is fighting inflation, Ray Dalio made it clear in an interview that there will be economic pain coming as a result. He said, "We are right now very close to a 0% growth year. I think it's going to get worse in 2023 and then 2024, which has implications for elections." He then added, "What the Federal Reserve will do will balance it. They will tighten monetary policy and take away credit until the economic pain is greater than the inflation pain." He singled out the housing and automotive industries in particular as facing stiff headwinds from raising interest rates. This is primarily due to the fact that many homes and automobiles are purchased with debt and under relatively favorable financing terms. The reason that financing is generally fairly easy to obtain is that these loans are secured by the underlying asset, i.e. the home or automobile involved, which is fairly easy for the lender to resell at near market value if the borrower defaults on their loan. Interest rates fell to all-time lows in the immediate aftermath of the COVID-19 outbreak as the Federal Reserve attempted to stimulate economic activity and avert a recession. Furthermore, the federal government distributed thousands of dollars to each American taxpayer in order to further stimulate the economy and help alleviate the economic hardships experienced by many as a result of the COVID-19 lockdowns and reduced consumer activity due to health concerns. This combination of extremely low financing and extra money in consumers' pockets resulted in extremely high demand for both vehicles and homes. As a result, following the COVID-19 crash, housing and automotive stocks outperformed the S&P 500 significantly. However, now with interest rates soaring and economic growth grinding to a halt in 2022, these sectors are seeing a sharp reversal, underperforming the S&P 500 year to date. Real estate currently accounts for 2.84% of the index, while automotive stocks led by mega cap Tesla as well as Detroit titans like General Motors and Ford, as well as several other automotive parts manufacturers and automobile dealers, account for 3.84%. This does not even include chip manufacturers like Nvidia, which would significantly increase this percentage if they were included. With automotive and real estate stocks accounting for nearly 7% of the index, their future prospects have a significant impact on the index's overall performance. Unfortunately, the outlook is not encouraging. Both sectors, as previously stated, appear to be in a Fed-fueled bubble that is now being popped by a sharp reversal in the policies that inflated it in the first place. However, there is the possibility of significant additional economic carnage beyond the bubble's deflation. This is due to the rapid decline and then dramatic rise in interest rates over such a short period of time, miscommunicating the true state of the economy to entrepreneurs and business executives, causing them to misallocate capital, potentially on a large scale, into higher risk, longer-term investments. It also encouraged people to buy houses and cars with cheap debt that they could no longer afford at current interest rates. This will almost certainly result in a massive and sudden drop in demand, as well as an increase in auto loan and even mortgage defaults if unemployment rises. All of this will increase inventory and, quite possibly, drive prices sharply lower. While these headwinds are not good for the economy, another question is whether the S&P 500 is cheap enough to buy right now. According to data compiled by Current Market Valuation, the stock market appears to be fairly valued right now. The yield curve, Buffett indicator, and price-to-earnings ratio models all indicate that the market is overpriced, whereas the interest rates, margin debt, and S&P 500 mean reversion models all indicate that the market is fairly valued. However, given the bearish macroeconomic outlook, it seems like wisdom would side with caution at current levels and wait for some margin of safety before buying the S&P 500 right now. Moreover, as Ray Dalio reasserted in his latest interview, cash is still a trash investment, given that the real interest rate remains negative. So when should one invest? Floating rate securities, if purchased at a reasonable price, are not a bad investment. However, in the current environment, interest rates frequently trail inflation rates unless a reasonable amount of risk is taken. Some BDCs have investment-grade balance sheets and fairly conservatively positioned investment portfolios almost entirely allocated to floating-rate debt, as well as excellent underwriting performance and are trading at significant discounts to net asset value. However, their loans are still more risky, and they may struggle during an economic downturn. Another strategy is to bet that a recession will force the Federal Reserve to reverse course and cut interest rates sooner rather than later, making regulated utilities and other recession-resistant high-yield businesses such as triple net lease REITs and MLPs appealing buys, especially while their share prices are suppressed.